Bollinger Band is one of the most versatile indicators. In markets that tend to be rather volatile, the Bollinger Bands can be very useful in determining price patterns. Reading the trends, timing entries during the range markets, and finding potential market tops in the dynamic adaptive manager. In today's video, we will discuss about the most important 10 trading rules and strategies you need to know about the Bollinger Bands. First, buy the lower Bollinger Bands in uptrends and sell the upper Bollinger Bands in the downtrends. The common approach when using Bollinger Bands is to identify overbought or oversold market conditions during trends, meaning you can look at the overall direction of price and the only take trade signals that align with the trend. When the price, if the asset in the uptrend, making higher highs and the lower lows, and breaks below the lower Bollinger Bands price, have perhaps corrected too much and are due to bonuses. When the price reach the lower Bollinger Bands in the uptrend, you have a potentially buy trade. On the other hand, then price is in the downtrend, making lower lows and lower highs, and breaks above the upper band or touches the band, the market is perhaps overbought and due for the pullback. Second, the Bollinger Bands for finding dynamic support resistance areas. Bollinger Bands are comprised of three lines. The middle bands is the moving average and the upper and the lower bands are positioned on entry side of the moving average. As the Bollinger Bands are based on the standard deviations, and because the market is evolving, something buying selling interest change is a way that isn't at the pre-designed horizontal levels. The Bollinger Bands moves as the price moves offer dynamic support and resistance, and in combinations with the classic support and resistance areas, the Bollinger Bands signals are even more reliable. Third, the Bollinger Bands are parallel price unlikely to stay outside the bands. After the price experiences a large up or the down movement, it will often consolidate or trading in the channel. The period of price consolidations present opportunities for taking shorter term positions using Bollinger Bands. For my experience, after a step upward or downward momentum in the price, the Bollinger Bands will flatten, and then there is a high probability that at least several backs and force momentum between the upper and the lower bands will occur. When bands are parallel, there is a higher chance that the price still stay within the bands instead of breaking and staying outside of them. So one of the most common ways of trading the bands is to buy when price are near the lower bands and sell price are near the upper range band during non-trending periods when there isn't clear directions force. Add the Bollinger Bands indicators to confirm volatility. The Bollinger Bands indicator illustrates a period of varying volatility relative to the market price movements. Basically, the indicator measures the percentage difference between the upper and the lower Bollinger Bands. So when the distance between the two out Bollinger Bands contract, the bandwidth indicator falls, and then the upper and the lower Bollinger Bands expand. The bandwidth indicator rises. The Bollinger Bands provides the better visual of price consolidations, low bandwidth values, and periods of volatility, high bandwidth values. During the period of the rising price volatility, the distance between the two bands will widen and the Bollinger Bands width will increase. Conversely, during the period of the low market volatility, the distance between the two bands will contract and the Bollinger Bands width will decrease. When the distance between two bands is relatively narrow, that is often a sign that a market may be about to intuitate produce move in easier directions. Fifth, search for Bollinger Bands squeeze patterns and wait for the imminent breakout. The distance between the outer Bollinger Bands depends upon the standard deviations when markets becomes too slow and there is a lot of volatility, the price moves sideways. A Bollinger upper and the lower bands becomes close to each other. This is called squeeze. An extreme contractions of the bands or a sharp narrowing of the bands implies that volatility is simply too low, at least from the historical percentage, and we could expect a significant advantage or decline in the immediate future. So when the bands squeeze together, it usually means that breakouts is getting ready to happen. If the candles start to break out above the top bands, then the move will usually continue to go up. If the candles start to break out below the bottom band, and then price will usually continue to go down. Of course, you need to pay attention on the other aspects because false breakouts will occur, so keep in mind that continuations of bands does not necessarily signal the specific directions of the next move. Rather, it only allows traders to prepare for increase in volatility and hiccup to exact and impulsive move in the near horizontal 6. Applying Bollinger Bands on other indicators. Bollinger Bands can be applied on the various tools, mainly to determine entry and exit signals. This helps in catching price spikes where corrections or pullbacks may start. Traders often apply bands on the relative strength index and take crossover signals. The trend is considered bullish when the RSI moves above and the middle Bollinger Bands. If the RSI line is below the middle bands, the market is considered bearish. You can also apply it to the MACD. A common strategy to find double tops on the MACD during the downtrends and the upper Bollinger Bands, or double bottoms during the uptrends at the lower Bollinger Bands. This is a great way to find price spikes on the chart, or you could apply it to stochastic indicator and pay attention to overbought and oversold levels on the oscillator outside the Bollinger Bands. Of course, taking into account support and resistance levels, here we have an oversold stochastic outside the lower Bollinger Bands occurring as support after stochastic crossover inside the banks. The price change directions. 7th. US Bollinger Bands in combinations with leading indicators. Bollinger Bands indicators is lagging, meaning it provides signals about the horizontal data of particular market. It moves after the price has moved lag aspects. For more reliable signals, you can add a leading indicator on your chart. This way, both classes of indicators will help you to get a better read on the market. Leading indicator anticipate price movements ahead of the time. The attempt to predict where the price is heading. Such indicators include pilot points, volume, or Fibonacci retracements. For example, we have a Bollinger Bands squeeze patterns occurring here. The bands became narrow range as volatility contrast. On the balance, volume showed accumulations during the trended bridge, and these sides of buying pressure increase the chance of the upside breakout. As the price closed outside the upper Bollinger Bands, we also had the another valid signal occurs when the price retreats to the middle Bollinger Bands area, which consider with the central pivot point. 8. Pay attention to the candlesticks patterns that touch the upper and the lower bands. The enhance accuracy of your trades when candlesticks are touching the upper and the lower bands. Observing the candlesticks patterns by helpful, especially when the spot reverse patterns. Here we have an inclusion setups, meaning two candles patterns that can signal the potential reversal at the market. Example, in this case, the lower Bollinger Bands, a hammer occurring at the lower Bollinger Bands represents another important pattern. The hammer is made up by the candlesticks with a small body, long lower shadows, and a small or next sets upper shadows. Morning star patterns at the lower Bollinger Bands could be another signals. Here, the red candlesticks confirms that the decline remains in forces and the selling domain. However, the decline shows significantly after this small candlesticks forms. The small candlesticks indicate indecisions and possible reversal of the trend. The third long candlesticks provides bullish confirmations of the reversal at the lower Bollinger Bands. 9. Search of the divergence at the upper and the lower bands. Divergence analysis is very useful, supporting in predictive future price behavior based on the current values. A divergence is an event that is associated with the increased level of volatility. A breaking divergence is when the market makes high highs, but the oscillators you're using RSI or stochastics, for example, prints lower highs, which is signal of the weakness. A bullish divergence is when the market makes the lower lows, but the oscillator shows the higher lows, and this is the sign of the trends. So how do you combine these signals with Bollinger Bands? Simple. If the price is upper Bollinger Bands, then you go to look for the bearish divergence. To indicate weakness in the underlying move and potential reversal to at least the middle Bollinger Bands. If the price is a lower Bollinger Bands, then you can look for the bullish divergence to indicate strengths in the underlying move. Hence, adjust the middle Bollinger Bands and its standard deviations for more price containment. Bollinger Bands are using the standard configurations of the 20 period simple moving average and bands of the two standard deviations from the mean. But the top of the bottom lines can be set at different settings based on your strategy for consistent price containment within the bands if the average period is increased. The number of the standard deviations also need to be increased. Likewise, if the average is decreased, the number of the segment deviations should be reduced. As a general rule of thumb, the shorter the period and the higher the standard deviation settings, the more likely the current price will be with the bands. If you learned something new and found value, leave us a like, show your support, subscribe to our channel, and hit the bell icon to stay in touch with me and release new video. Until next time.